Rich entrepreneurs don't avoid taxes, they avoid taxable income. And if that sentence doesn't make sense yet, that's exactly why most people overpay every single year. If you made six figures last year and paid taxes on nearly every dollar, personally, there's a strong chance you're structured wrong. Today I'm going to break down how wealthy entrepreneurs legally reduce their tax burden, how holding companies actually work, why retained earnings build leverage, how timing shifts exposure, how business credit fits into the ecosystem, and why the tax code rewards ownership, not employment. This isn't about cheating. This isn't about hiding money. This is about understanding how money flows inside the rules. What's going on, y'all? I'm Key Whitlow, aka Moneybag Key, aka Mr. No Excuses. I built a six-figure business from my bed using nothing but my phone, leverage, business funding, and digital systems. When I started 6 years ago, there was no AI helping me model entity structures. There were no automation tools breaking down compensation strategy. I had to learn through denial letters, restructuring mistakes, trial and error, and studying how capital actually flows in the real world. I had to understand why some entrepreneurs scaled faster while others stayed stuck even though they made good money. Now we've got AI, now we've got automation, now we can analyze structure before making decisions. And today I'm going to show you how structure completely changes your tax reality. Before we go deeper, I created a free AI business structure and funding training. It walks you through how to position your entity properly before scaling or applying for funding, because leverage without structure becomes dangerous. Grab it below after this video. Now let's break this down clearly. Part 1, the real difference, income versus ownership. The biggest misunderstanding online is that rich people don't pay taxes. That's not true. They absolutely pay taxes, but they don't earn income the way most people do. Let's compare two scenarios. Person A earns $300K as a W-2 employee. Person B owns a company that generates $300K in net profit. Same number, completely different experience. The W-2 earner pays federal income tax, pays state income tax, pays Social Security, pays Medicare, has limited deductions, has no control over timing. Income flows straight to personal exposure. There's no pause, there's no decision point, there's no structure layer. Now person B, their business might generate $750K in revenue. After $450K in legitimate operating expenses, payroll, marketing, contractors, software, insurance, professional services, equipment, they are left with $300K net profit. Here's where everything changes. The business owner decides how much of that $300K becomes personal income. The employee does not. Revenue is not taxable income. Profit is not automatically personal income. Personal income is where the highest exposure hits. Structure determines how much crosses that line. Part 2, strategic distribution. Example, let's break this down deeper with numbers. Business profit, $300K. Owner only needs $140K for lifestyle. They distribute $140K. That $140K becomes personal taxable income. The remaining $160K stays inside the business as retained earnings. Now compare that to the W-2 employee earning $300K. They do not have the option to retain earnings inside an entity. They get taxed. End of story. The entrepreneur controls flow. Flow determines classification. Classification determines exposure. Exposure determines outcome. That's the shift most people never understand. Part 3, retained earnings build leverage. Retained earnings are not just leftover profit, they are strategic capital. That $160K sitting inside the business can strengthen the balance sheet, increase lending eligibility, act as collateral strength, fund marketing expansion, purchase revenue generating assets, create acquisition opportunities. Banks evaluate financial strength when approving funding. Retained earnings show stability. Stability increases trust. Trust increases access. Access increases scale. Most entrepreneurs drain profit to show personal success. Wealthy entrepreneurs build strong entities quietly. They think in systems, not optics. They build machines, not moments. Part 4. Holding company structure. Explained clearly. Now let's layer strategy. Operating company generates revenue. Holding company owns operating company. Operating company can pay management fees or distributions to holding company. This reduces taxable income at operating company. Holding company now controls capital. Important, both entities still report income. Nothing disappears. Nothing is hidden, but now capital is positioned strategically. Holding company can acquire real estate, purchase intellectual property, invest in other businesses, own multiple subsidiaries, lend money internally between entities, separate assets from operations. This creates insulation, it creates flexibility, it creates layered control. Instead of income flowing directly to your personal account, it flows through structure. Structure reduces unnecessary exposure. Part 5. Timing as a strategic tool. Timing is power. If your business expects higher income next year, strategically accelerating or deferring certain legitimate expenses can affect taxable positioning. Revenue received in December versus January changes tax year classification. Compensation timing changes exposure. Asset purchases can shift deduction schedules depending on classification. Employees don't control timing. Business owners often do. Timing flexibility equals strategic advantage. Strategic advantage reduces exposure. Part 6. The incentive system. The tax code incentivizes economic activity. It rewards hiring employees, purchasing equipment, investing in growth, expanding operations. That's why deductions and depreciation exist. When businesses buy equipment or invest in operational infrastructure, those purchases may reduce taxable income over time depending on classification. The government wants businesses creating jobs and economic activity, so the system rewards productive ownership. It does not reward simple wage earning the same way. Ownership changes how the system treats you. Participation in the expansion creates different treatment than participation in wages alone. Part 7. Funding plus structure acceleration. Now let's add business credit. If your structure is strong and your financials are clean, you can unlock business funding. Imagine this: 160K retained earnings, 200K business credit. Now your ecosystem controls 360K deployable capital. That capital can fund large-scale marketing campaigns, expand operational capacity, acquire revenue-producing assets, increase automation systems, invest in new ventures. Instead of using personal income to scale, you deploy structured leverage. Leverage multiplies growth speed. Growth compounds wealth. Structure determines how safely that leverage is deployed. Part 8. The common mistake. Most entrepreneurs generate profit, then drain it personally. Luxury spending, large withdrawals, lifestyle expansion. Then they complain about taxes, but they triggered exposure. If your business earns 400K and you withdraw all 400K personally, you converted corporate leverage into personal taxable exposure. Wealthy entrepreneurs ask, what strengthens the ecosystem long term? Not, how big can my personal withdrawal look this year? That mindset shift alone separates operators from earners. Part 9. The psychological shift. Most people chase income. The wealthy chase control. Most people think in 1-year cycles. The wealthy think in decades. Most people want bigger paychecks. The wealthy want stronger entities. Income without structure increases exposure. Ownership with structure reduces unnecessary exposure. Flow determines classification. Classification determines exposure. Exposure determines outcome. Control flow, control outcome. Part 10 AI advantage in 2026. Years ago, entrepreneurs learned this through painful trial and error. Now we have AI. You can model revenue growth projections, different entity elections, compensation splits, distribution timing, retained earnings growth, funding eligibility scenarios. You can analyze multiple structures before making irreversible decisions. You can simulate outcomes before executing. That reduces mistakes. That increases precision. Precision accelerates wealth building. There is no excuse to operate blindly anymore. The goal isn't to eliminate taxes. Taxes are part of participating in the economy. The goal is to eliminate unnecessary exposure. Structure determines flexibility. Flexibility determines leverage. Leverage determines growth. Growth determines wealth. Stop chasing income without structure. Start building entities with intention. Start retaining capital strategically. Start thinking in ecosystems instead of paychecks. If this shifted your thinking, comment structure, and I'll break down holding company layers even deeper next.
We came from the bottom, now we leveling up. Level up. Credit clean, bankroll steady, we up. We up. No excuses, we don't talk, we just do.